Hello, and thank you for joining us for the TM Tax Practices video series, Getting Ready for Tax Season. This is video 4 of 9, where we will be looking at standard versus itemized deductions. And before we jump right into those two things, there were a few things I wanted to go over just to kind of show you how we even get to the standard and itemized deductions and your taxable income, so you can understand that part a little bit better. I'm going to try to quickly go through this, and that's starting with your adjusted gross income, or AGI. Now, you may have heard me refer to the AGI in prior videos, and certainly will hear me refer to it in videos to come, but what that is it's going to be a very important amount for you to look at to determine if you qualify for a variety of benefits as it relates to tax, and the limitations as it relates to tax, okay, on a lot of things. So we're going to look at how we calculate the AGI. Very simple way to look at it, right? So we're looking at income and losses, and that's going to be pretty straightforward. That's going to be your W-2 income from your employer. That's going to be your investment income, so any dividends, interest income, maybe at capital gains or capital losses. Your retirement income, so if you took any distributions from a retirement account, that's going to be included in there. And your business income and losses, so if you're a sole proprietor, or perhaps you have a K-1 flowing through to you from a partnership or an S corporation, and those activities have a gain or a loss, that is going to be included in this amount, and that's going to result in basically your net income. And then we have adjustments to that, deductions to that, but they're called adjustments. And some of the common adjustments, not all, but some of the more common adjustments are going to be the educator expense. So if you're an educator, a professor, a teacher, and you had out-of-pocket expenses used for the classroom, those are allowable adjustments to income. Likewise, any contributions to a HSA or a health savings account. If in your sole proprietorship, your business activity, you did have a gain and it was subject to self-employment tax, half of that self-employment tax is going to be an adjustment to income here. And any retirement plan, qualified retirement plan contributions that you make can be an adjustment to income here. And we're talking about SEPs, simples, qualified plans, and IRAs. Again, qualified contributions within the limitations will be an adjustment to income. Now, this is how we arrive at our our adjusted gross income, by taking that net income and loss and deducting these adjustments from them. That's our AGI. Then next, we're going to look at taxable income, right? So how we're calculating our taxable income, or our total taxable income, is going to be our adjusted gross income, AGI, less our standard deduction, which we'll talk about in a moment here, and any charitable contributions you may have made, which is up to $300 or $600 married filing jointly for 2021, and your QBI, or qualified business income, so your flow-through income deduction that you may be qualified for there. The other option is going to be your AGI less your itemized deduction, which again we're going to talk about in this video, and your qualified business income deduction. So with the standard deduction, they're also allowing you to go ahead and take a deduction of up to $300 or $600 married filing jointly with your standard. Now with your itemized, any charitable contributions are going to be included in that itemized amount, okay? Now your standard deduction. If you're taking your standard deduction, we're going to look at your filing status, and that's going to take you to what your standard deduction is. Now, if you are age 65 or over, or considered legally blind, you are going to have an additional deduction that we can look at, okay? So on the standard deduction, if you are single, you are unmarried, and you do not have any dependents, no qualifying relatives or qualifying children, your standard deduction for 2021 is going to be $12,550. Now, again, if you're over or age 65 and over, or legally blind, you're going to get to add an additional $1,700 to that. So your standard deduction is going to be $4,250. Likewise, if you qualify as head of household, and qualifying for head of household basically means that you are unmarried and you do have a dependent, a qualifying child or a qualifying relative, your standard deduction is going to be $18,800. And again, you get to add an additional $1,700. That additional deduction goes down a hair when you're married filing jointly. That standard deduction is $25,100. And if one spouse is over age 65 or blind, you're going to add $1,350, double that up for both spouses. Okay. Now, I went ahead and added the table here for the standard deduction for 2022, so you can get a preview of what we're going to look like this year. Those standard deductions did go up slightly. The additional deductions did go up slightly as well. So, when are you not eligible for the standard deduction? Well, one thing that you did not see in the standard deduction table or one filing status is married filing separately. You are not eligible for the standard deduction if you're married filing separately and your spouse is itemizing. Okay, you both are going to have to itemize in that case. If you're a non-resident alien or dual status alien, now there are some exemptions or exceptions to that, but in general, if you had a change in accounting period, less than 12-month tax year, you're not going to be eligible for the standard deduction. You're going to have to use the itemized. Estates and trusts are not eligible, okay? Now let's look at the itemized deductions. There is no limitation on the total amount of the itemized deduction you are eligible to take. That is important because there did used to be a limitation on the total itemized deductions you were allowed to take for the year. Now there are none. In the itemized deductions, you have medical expenses, and we'll go over those. State and local tax, referred to as SALT, we'll go over those. Interest expenses, gifts to charity or charitable contributions, casualty, theft, loss, and other itemized deductions. This is basically your list of all of the types or categories of expenses that will be considered for itemizing. So getting into the medical expenses. So there is a limitation on the medical expense, and it has fluctuated between 10% and 7.5%, but right now it's the 7.5% floor. And what that means is you're going to calculate 7.5% of your adjusted gross income, the adjusted gross income we talked about a little bit ago. And any medical expenses you have in excess of that 7.5% of AGI is the deductible amount of medical expenses. So what expenses qualify as medical expenses? Well, there are a lot. So any premiums, medical, dental, vision, insurance premiums will qualify. And chiropractors do qualify. Any examinations, x-rays, labs, diagnostics, scans and tests, hospital care, medical aids such as eyeglasses, hearing aids, any lodging expenses if you had to travel for medical care, ambulance services, or your own gas is going to be deductible as a medical expense. Now, your own gas is only going to be deductible at 0.16 cents a mile, okay? Non-deductible expenses, on the other hand, any non-prescription medications. Typically, we're talking about things like vitamins and supplements, over-the-counter, maybe some cough syrup, things like that. Non-prescription medication is not deductible. Prescription medication is deductible. Cosmetic surgery, elective surgery, not deductible typically, unless, even though it's considered a cosmetic surgery, but it was something that your doctor has prescribed for you to do for a medical condition, then it would be deductible. But elective cosmetic surgery is not deductible. Diet, food, gym memberships, those are not deductible as medical expenses, okay? SALT, state and local tax, okay? So the limitation, there is no limitation on the total of itemized deductions, but there is a limitation in the total of state and local taxes that you can deduct, and that is going to be $10,000. So that's going to be your income tax or the general sales tax. Now, the general sales tax is going to be the actual, so you have actually kept track of all of your receipts for all of the sales tax that you paid throughout the year, or you can use the optional table. There is a table provided for every state for a general sales tax deduction. So again, it's going to be either your actual income tax or your general sales tax. Provided a little map here of all of the states with no income tax. So if you're in a state with no income tax, and you likely know whether you're in a state with income tax or not, if you're in a state with no income tax, you're going to be taking the general sales tax. If you are in a state with income tax, then you do want to look at whether that general sales tax is going to be higher than the income tax and take either or. You can take the higher of the two. Real estate taxes will be deductible in state and local taxes. So this is your yearly assessed real estate taxes. The taxes that you are going to be able to deduct are the taxes that you paid in the year. And one thing I do want to mention as it relates to this is you cannot prepay. So I say here, the year it is assessed and the year it is paid. Okay, so you're not going to be able to deduct any prepaid property taxes. Personal property tax typically is going to be things like your vehicle registration, and some other taxes that you can deduct may potentially be foreign tax, but there are other ways to take advantage of tax credits and exclusions from income if you have foreign income. So you might want to look at that before you look at itemizing any foreign. And then there's the generation skipping that you may be able to take advantage of. Generation skipping tax you may be able to take advantage of here. But again, the state and local tax is limited to a total of $10,000 that you're able to take. So if with your income tax or sales tax, your real estate tax, your personal property tax, you haven't reached $10,000 and you're not able to take advantage of the other taxes, then yes, that may be where you want to use these. But otherwise, any other taxes that may be qualifying as deductible, there may be other places you want to look to take advantage of those. Interest. So when you're itemizing, there are items of interest that you may pay. And this is mostly going to be related to your home, your primary residence, your secondary. So if you have a mortgage on that, a second, you're going to be able to look at taking some of those expenses as a deduction when you're itemizing. So again, if it's your main or second home, you're going to be able to qualify here. If it is acquisition debt, so you acquired the debt to acquire the property or improve the property, then that debt is going to qualify. The interest paid along with that debt is going to qualify. The limitation on the home mortgage interest deduction is going to be before 2017, $1 million. So your mortgage debt of $1 million, interest paid on mortgage debt up to $1 million before 2017 is going to be deductible. After 2017, this is the Tax Cuts and Jobs Act, that limitation went down to $750,000. So If you acquired a property after 2017, you are going to be able to deduct the amount of interest for debt valued up to $750,000. Equity debt is not allowable as a deduction here. The equity debt would be allowable as a deduction if you use that equity debt to improve the home. But now that you've used the equity debt to improve the home, it goes back and pushes itself back up to acquisition debt. Okay? If you use that equity debt for anything personal, like maybe you bought a car or something like that, it's not going to be allowable here. If you use that equity debt to buy a second home, that is going to push you back up to the home mortgage interest acquisition debt, and it is deductible. If you use that equity debt to purchase an investment property, say you're going to rent that property out, the interest on that may very well be deductible, but it is not going to be deductible here as an itemized deduction. It's going to go along with your business deductions, okay? So you also get mortgage interest points under the interest area and mortgage insurance premiums. Now, if you have points and premiums, you likely know what those things are, but the mortgage insurance premium, so if you paid less than 20% of a down payment for the home, you may actually have mortgage insurance premiums that you're paying, so check for that, and you want to be able to deduct those. So the limitation is going to be $100,000 and phase completely out at $109,000. Okay, so if you're single, that's going to be $50,000 to $54,500. Investment interest is also deductible here, but investment interest is only deductible up to the amount of interest income. Okay, so now we're going to look at gifts to charity or charitable contributions. And first of all, it has to be a gift to a qualified charitable organization, so a 501c3 nonprofit. Okay? If you were to give a gift to a friend, a relative, just someone you feel is in need, maybe you went on GoFundMe, that is not going to be deductible here. It has to be a gift or a contribution to a qualified charitable organization, a 501c3. You can check this website, irs.gov, to check and see if the organization that you're contributing to is listed as a qualified charitable organization. Now, as for the actual deduction, if you made a cash contribution, you are going to be able to deduct up to 60% or 100% of your adjusted gross income. So if you made a charitable contribution in 2021 of $50,000 and your adjusted gross income was $45,000, you are only going to be able to deduct $45,000. Now, it's 100% of AGI for 2021, but that may go back to 60% in 2022. We'll have to wait and see. For any non-cash contributions, it's going to be deductible up to 50% of your AGI for personal property, 30% for capital gain property. And typically that capital gain property we're talking about is going to be like stocks. So if you made a charitable contribution of in your brokerage account of stocks and bonds, that's going to be at 30% of the value of the account. Your volunteer expenses, any volunteer services you provide, those are not deductible. So the fair market value of the services you provide is not a deductible expense. However, if you incurred expenses for volunteering, while volunteering, those expenses may be deductible here. And such as mileage, if you had to drive as a part of your volunteering, you're going to be able to take the charitable mileage expense of 14 cents a mile. Or you can look at the actual gas that you did spend. Now, there is an exclusion to your charitable contribution if you received a benefit, right? So, as an example, if you contributed $1,000 to attend a charity gala, then the value of that dinner was $250. Your deduction is $750 because you received a benefit valued at $250. So you're going to get that $750 deduction, not the full $100. And then after that, we're going to have to go right back up to that cash limitation and look at your adjusted gross income. If your adjusted gross income was more than $750, you're going to get the full $750 deduction. So we also have the casualty and theft loss deduction. That is only available generally if there was a federally declared disaster, okay? And there are limitations on the casualty and theft loss deduction, and that is, number one, it has to be more than $100, okay? So we start there. And number two, there is a 10% floor of your adjusted gross income. So I'll give you an example. Let's say that your adjusted gross income was $20,000 and there was a federally declared disaster, a storm, and that caused damage to your garage of roughly $10,000. And the insurance company was good enough to pay you out a whole $6,500, not quite enough to get it done, and you had to come out of pocket for that, right? So now your total loss is $3,500. So first we have to reduce that by $100. So now we're at $3,400 allowable. Then we have to subtract 10% of the AGI. We have that 10% AGI floor, and that's going to be $2,000. So now we have a deductible loss of $1,400 that we can take as an itemized deduction for your casualty and theft loss. But the biggest takeaway here is that it must be a federally declared disaster. And the pandemic, COVID-19, was in fact a federally declared disaster, by the way. So your other itemized deductions, you're going to be looking at gambling losses, okay? So this isn't all, but this is some of the other itemized deductions. Now, your gambling losses will only be deductible up to any gambling winnings that you claimed in income. Your casualty and theft loss of income producing property. Now, this can be an itemized deduction. Typically, though, it's a deduction that you would go ahead and take with that income producing property, being that it is a business property, right? So we may actually go ahead and deduct that over there. And any impairment related work expenses of disabled persons, those are deductions allowable under other and available for you to itemize. I do hope that you guys enjoyed the video and was able to take some good information away from it with you. If you have any questions, you can always reach out to us at info@tmtaxpractices.com. Visit us on our website at www.tmtaxpractices.com to check out more resources and videos. Like, follow, subscribe on YouTube, Facebook, and LinkedIn.